If you want a copy of this discounted cash flow model, just email me, I'll send it to you. Let me show you how it works. I'm going to use Meta as an example. First, enter the name of the company, Meta, put today's date equals today, parentheses, 11/17. Keep the exchange rate at 1 unless you're doing a foreign company. So 1 for the exchange rate. So let's enter everything in the blue box. We need market cap. I'm going to use Yahoo Finance to get the information. So I pulled up Meta already. Let's scroll down. Market cap 1.399. You could just copy that. 1.399. That's 1.399 trillion. So I'll multiply that by a trillion. 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. It looks like 1.399 million, but all numbers on this file are in millions. So that's just formatting. Next, we get the stock price, 554.08. And you could use any website. I'm just using Yahoo Finance since I'm used to it. Now we need the most recent revenue. I put trailing 12-month revenue, but the most recent revenue could be for the full calendar year. Let's go to Yahoo Finance, go to Financials, scroll down, and I'm going to screenshot this. This is the income statement on top. Their trailing 12-month revenue is 156.2 billion. So just enter the full number always, 156, 227, 123, 123. If you're doing Yahoo Finance, you have to add 3 zeros. All numbers are in thousands. And now enter the prior year revenue, which was their 2023 revenue, 134.9 billion. So let's enter that, 134,902, 123, 123. Next, we need the terminal value growth rate, which is how much the free cash flows will grow after the 4th year. Usually it's between 1 and 2.5%, but you don't want to go above 2.5%. So with a good company like Meta, I'm going to put 2.5%. WACC is a discount rate. I recommend using Finbox. Just go to finbox.com, hit the search bar, and type in your ticker, META. I'm going to click on Meta, and then click on Models right here, and then scroll down to Cost of Capital, hit View, and this gives you 3 WACCs, a low, medium, or high. I use the middle a lot, but you can use whatever you want. And the last input is annual free cash flow. You can go to any website. I'm going to Yahoo Finance. We're at the financial section. I'm going to click on cash flow and scroll down. I'll take the trailing 12-month free cash flow, 52.1 billion. So the annual free cash flow is 52.1 billion. Make sure you enter the entire number, 52,100, then 6 zeros. 1, 2, 3, 1, 2, 3. That's 52.1 billion because everything's in millions. If you miss a zero, it says 5210. This is 5.2 billion. So make sure you don't miss a zero or add a zero. And that's it. Our calculated stock price for Meta is 488. It's trading at 554. So it's trading at a 14% premium. It's a sell according to the model. Let's do a ticker that has negative free cash flow. We're going to do MPW, Medical Properties Trust. So enter the ticker. Let's put the date in, today's date. Now let's get the market cap. We'll go to Yahoo Finance. They're at 2.588 billion. So we'll copy that. And we have to multiply it by 1, then 9 zeros. So this looks like 2,588, but all the numbers are millions. So that's 2.58 billion. And you can see it says 2.58B for billion. Now what are they trading at? 431. We'll copy that. Let's get the revenue numbers. We'll go to Yahoo Finance, go to Financials. And the great thing about revenue is it can't be negative. Let me get a screenshot of this. So this looks bad. Their revenue has gone down. Let's just put in what they have. 641,320,123. We always add 3 zeros for Yahoo Finance. Let's enter last year's revenue, 871,799,123. Terminal growth rate, let's just use 2.5%. The WACC, we'll go to Finbox. Let's go to search, type in the ticker, MPW, Medical Properties Trust. If you don't know the ticker, you could type in the company name, Medical Properties, and it's right here. Now let's go to Models, scroll down to Cost of Capital, hit the View, and it's really high. Let's copy this. Let's use the lower one because it's so high. All 3 are so high. 15.5. That's the WACC, the discount rate. Let's get the annual free cash flows. We'll go back to Yahoo Finance, go to cash flow. I guess I just assume they have negative free cash flow. They actually have positive free cash flow. Let's just pretend, for the sake of the video, it's negative 304 million. So we'll put negative 304,214, then add 3 zeros. So the calculated stock price is negative $1.40. It's impossible to have a negative stock price. So now we have to do some massaging to the model. In order to get a real value, they have to generate positive free cash flow at some point. This looks real bad. We're forecasting their revenue to decline. The revenue estimate for next year is 470 million. In 2026, 347 million. 2027, 255 million. 2028, 188 million. And the way we calculate our free cash flow, we take our revenue times free cash flow over revenue. And free cash flow over revenue is the annual free cash flow over the trailing 12-month revenue. That's a percent of their revenue they convert to free cash flow. Since it's negative, we need to change at least something in the model to get a real value. What I like to do is I like to go back to their free cash flow and just pretend this is negative for the sake of the video, just this number. And we look at their prior free cash flows and they're all positive. The lowest is 505,786. So let's take the lowest to be conservative. And let's say by the 4th year out, their free cash flow is the 505 million, which they actually did in the past. So put that here and then add 3 zeros. Now we have a hard-coded number here. So don't use this model again. Make sure you use a clean model. You can highlight it so it stands out. So in this model, we're assuming their free cash flow is 500 million by the 4th year. And then we calculate the terminal value based off of the 4th year. We use the same formula as a dividend discount model. You can just go into the cell and try to pick apart the formula so you understand it. If you've done a lot of due diligence on this company, you may have a little more information. So you might say to yourself, well, 15.5% WACC may be the WACC today, but 4 years from now, the company will probably be in better shape. Because the reason the WACC is so high and the stock price has come down is because one of their tenants has defaulted, their biggest tenant. We're going to make the assumption their largest tenant, Steward, is in better financial shape 4 years from now and can pay their lease payments in full. So we think 15.5% is probably too high. Let's bring it down to 10%, which is still on the higher side, but I think that's reasonable. Now the stock price is worth $7.72. It's trading at a 44% discount. If you're really bearish on this company and you don't think they're ever going to get positive free cash flow, just don't buy the stock. And there's no need to do a DCF or short the stock. There's lots of things you can do to massage the model to get a different value. Discounted cash flow models are an art, not a science. You don't want to just plug in numbers and that's it. You want to understand the model. Because just running DCF models will not make you a successful investor. This is just a tool to help you. In the short term, the model could help identify a really undervalued stock. In the long term, nobody really knows. How can you predict a company like Nvidia or Meta? How can you predict a company will get that big? It's just not possible. You can't predict a stock price 20, 30 years in the future when they IPO. You might get lucky, but you can't do it with accuracy consistently. Let me show you another model. This is the 8-year DCF. We'll continue using MPW, Medical Properties Trust. So I have everything inputted, market cap, stock price, etc. With this model, you can adjust the future revenue. Let me show you the previous model. The revenue estimates went down by 26.4%. The way I forecasted 2025 revenue, I took the trailing 12-month revenue, 641 million. If you hit F2 in this cell, you can see 641 lights up. Then I multiply it by negative 26.4%. That's how I forecasted revenue next year of 472 million. And the way I got negative 26%, it was how much the revenue declined from last year to this year. Revenue last year was 872 million. Revenue this year, 641 million. A decline of 26.4%. So my revenue decreases 26.4% each year. In my 8-year model, I also have revenue declining 26.4% in 2025. But now it's up to you to enter the revenue change over the next 7 years. So let's pretend they have negative 20% revenue the following year. So in 2026, revenue down to $377 million. Let's say it's down 5% after that. Now it's down to $359 million. Now let's pretend they start to grow their revenue. Let's say they grow at 5% the following year, then 8% after that, and then we'll just pretend 10 each year after that. 10, 10, 10. Because most companies don't grow forever or decline forever. There's usually ups and downs. So this model gives you that flexibility. So the free cash flow estimate is pegged to the revenue. The way I calculate first year free cash flow, which would be 2025, I take the $472 million, multiply by the 47.4%. And the way I got 47.4%, that's the percent of their revenue they converted to free cash flow. They generated $304 million of free cash flow in the trailing 12 months. But if it was a regular company like Meta, remember Meta, they had positive growth. Their revenue grew 16%. If you wanted to do an 8-year DCF for Meta, you could make all these numbers the same. They could all be 15.8%. You can really make them whatever you want. So if you do more research and due diligence, now you could change the WACC, you could change the terminal value growth, you could even change the revenue numbers, the revenue growth. So you could do a lot of massaging with the numbers. I redo my DCF for Meta every quarter for my own personal use because every quarter they come out with new numbers. So I update my revenue, my free cash flow. There's other external factors. Say Meta's in a lawsuit and I'm concerned that's going to really affect the company. So maybe I would raise the WACC or maybe I would lower the free cash flow. So there's a lot of things you can do to alter your numbers to try to give you the best estimate possible. Nobody can predict the future, even Warren Buffett. He just uses past information, current information, and his knowledge of the market to predict the future. So just email me if you want a copy of this model. My email is right here. And I'm going to come out with other Excel models. So try to support the channel. I'm not saying financially. Try to support it by watching videos, commenting, liking videos, and of course subscribe. And I'll keep providing Excel models for free, which should help your due diligence and possibly your Excel skills. So if you want to do me a big favor, click on the video in the top right corner and watch it. Try to watch it multiple times. I think it'll really help you understand the income statement, the balance sheet, and statement of cash flows. Thanks for watching.